Welcome to another bar walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over bar area 1. This is section B1. This is an application topic. Prepare a budget using supportable assumptions. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. Again, in that free 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. So make sure you check that out. And after you check that out, you're going to want to learn more. So make sure you also check out becoming a SuperfastCPA Pro member. Pro members get access to a lot of great stuff, including the Pro course, where Nate explains in detail exactly what you're supposed to be doing every day to pass the exams. It's basically a more in-depth version of the webinar. And also, Pro members get access to the full versions of these YouTube videos. So in today's video, we're only going to be going over 5 questions, but SuperfastCPA Pro members will get access to the full 10-question version of the video when we post it in the member forum. So if you like this and you like our other products, make sure you check out becoming a pro member because again, you'll get access to the full versions of the videos to get a little bit more help and a little bit more understanding. Now with all that, let's dive straight into the questions. All right, here we are at question 1. And something I always like to point out is you want to read the last sentence of the question first. Now, in some situations, it might not be that helpful because maybe there's only 2 sentences, like in this case. But this is a very good strategy and a very good habit to be in because on test day, you have no idea what you're going to be seeing. So if you read the last sentence of the question first, it will frequently give you context for what the question is about, so that as you're reading through the rest of it, you kind of have an idea of what you're looking for right from the start, instead of finding out what you need to be doing at the very end of the question. So again, read the last sentence first. Let's do that here. Which of the following sequences best reflects the natural flow of the budgeting process? Okay, let's go up to the top. A company is preparing its annual budget for the upcoming year. To ensure consistency and supportable assumptions, again, which of the following sequences best reflects the natural flow of the budgeting process? So if you know anything about the budgeting process, you might already know the answer, but if not, that's okay. We're going to go through the options and then the explanation to kind of understand what this is even getting at. So option A would be the cash budget to the production budget to the sales budget to the cost of goods sold budget. Option B would be the production budget to the direct labor budget to the sales budget to the budgeted income statement. Option C would be the sales budget to the production budget to the direct materials or direct labor and overhead budgets, and then to the cost of goods sold budget. And then option D is capital expenditures budget to the direct labor budget, to the sales budget, to the ending inventory budget. So again, what's the typical flow? Which budget do you usually do? And then what do you do after that budget and so on? Which one is first and then what follows after? Now, again, if you know, that's great. If not though, that's okay. We are going to use this question to start learning more about how to prepare a budget. And this is kind of the base for it. So let's go ahead and dive into the explanation together. All right, here we are at the answer C. So first you start with the sales budget, then you would go to the production budget, then you would go to the direct materials, direct labor, and overhead budgets, and then you would go to the cost of goods sold budget and so on. So let's kind of talk about that. The budgeting process typically starts with the sales budget, since projected sales determine production needs. From there, the company prepares the production budget to plan how many units to produce. This leads to the direct materials, direct labor, and manufacturing overhead budgets. These feed into the cost of goods sold budget, which is used in preparing the budgeted income statement. This sequence ensures each step is based on realistic, supportable inputs from the prior stage. So again, just to reiterate that, most of the time, the budgets start with the sales budget because that is going to be the driving force for the rest of the budgets. You create the sales budget so that you know how much you're trying to sell, you know how much money you're trying to make, and then based on that, you then create the production budget so that you know how much you need to produce. But once you know how much you need to produce, you then need to figure out the budget for the materials, for the labor, for the overhead that is going to be needed for that production budget. And then once you know that, you're going to know the cost of goods sold and maybe the cash budget and so on. Again, it all flows from the sales budget because that is where you start. And then based on what you want to do with sales, you create the other budgets so that you can actually meet that sales budget goal. So again, you start with sales budget almost always, and then from there it goes to the production budget, and then to the materials and variable costs budgets and things like that, and so on. So that's kind of the base of understanding how to prepare a budget. Now let's go to the next question to start learning more about actually preparing a specific budget. All right, here we are at question 2. Again, reading the last sentence first. How many units should the company plan to produce in March? Okay, let's go up to the top. A company is preparing its production budget for March. Budgeted sales for March are 14,000 units, and sales for April are expected to be 15,000 units. The company requires ending inventory each month to equal 20% of the following month's sales. Beginning inventory for March is 2,600 units. So again, how many units should the company plan to produce in March? So this is something that's pretty straightforward. It's not very complicated once you know how to do it. If you know how to do it already, that's great. Maybe pause the video and try it on your own. but we're trying to figure out based on how many they need to have at the end of the month, how many they already have, how many units do they need to produce in March to meet all these different requirements. If you know, that's great. If not, let's go ahead and take a look at the explanation together. All right, here we are. The answer is B, 14,400 units is how much they need to produce in March. So let's go through this. To calculate the number of units to produce, you take the budgeted sales plus the desired ending inventory less the beginning inventory, or you could even flip that. Sometimes I do that in my head. Budgeted sales less the beginning inventory plus the desired ending inventory. Either way, it's the exact same. So it's really not too complicated once you know how to do it. So we take the budgeted sales for March, 14,000. So that's how many they want to sell. So they have to at least have 14,000 units to sell in March. So that's what we start with. The desired ending inventory is 20% of April sales. So they need to not only sell the 14,000, but they still need to have 20% of April sales on hand at the end of March. So that's 20% of 15,000 that they want to sell in April. That's 3,000. So they want to have an ending inventory of 3,000 units to be able to more easily meet the sales target in April. And then we already know the beginning inventory is 2,600 units. So production needs to be 14,000 units for March, plus the 3,000 that they need going into April, less the 2,600 that they already have. And so they only need to produce 14,400 units to meet all of those different requirements. That makes it so that they have enough produced in March while also having enough inventory at the end of the month going into April. So that is one piece of budgeting. Again, figuring out the budgeted production for certain sales in a given month. Now let's go to the next question. All right, here we are at question 3. How many pounds of raw material should Morgan Co. budget to purchase in May? Let's go up to the top. Morgan Co. is preparing its direct materials purchases budget for May. Each unit of finished product requires 4 pounds of raw material. Budgeted sales for May are 10,000 units. The company wants ending inventory of finished goods to be 20% of the next month's sales. June sales are projected to be 11,000 units. Beginning inventory for finished goods on May 1st is 1,800 units. Morgan Co. also requires ending raw materials inventory to be 10% of the next month's production needs. Beginning raw materials inventory on May 1st is 4,000 pounds. So how many pounds of raw material should Morgan Co. budget to purchase in May? So there's a lot going on in this question. We might have to figure out how many sales they need to have, how many units they need to have, but also we need to figure out in the end how many pounds of raw material they need to be able to meet all those goals. Now, based on what we learned, you might be able to apply what we learned in question 2 to this situation. It's just a few more steps. So if you want, give it a try. If not, that's okay. We're going to go ahead and look at the explanation together right now. All right, here we are at the answer, A, 42,000 units. So that is the amount of raw materials they need to have purchased to be able to meet all their needs for this month. So let's go through this. First off, we need to figure out how many finished units they need to produce. So how many finished goods do they need to have in the end? So we start with the 10,000 that is in May. That's how many they want to sell in May. Then we add the ending amount from June that we want to still have in inventory. So 20% of June sales needs to be still in inventory at the end of the month. And then they already started with 1,800 units completed in the beginning inventory. So 10,000 plus 2,200 less 1,800 means that they want to have 10,400 units finished in May. Now, what does that mean as far as raw materials? We take the 10,400 units, multiply it by the 4 pounds per unit that we need to create the unit. So 41,600 pounds to be able to create those 10,400 units. Now we can figure out how many raw materials they need to purchase to be able to meet those needs. So now we go to the desired ending raw materials inventory, which we know that next month's production is going to need 11,000 units, which takes up 4 pounds per unit. So 44,000 pounds is how many pounds they're going to need next month. But remember, they want to end the month of May with 10% of the raw material needed for the next month's production. So 10% of 44,000 pounds is 4,400 pounds. So that's how many pounds of raw material they want to have on hand at the end of the month so that they can be ready for the next month. So we take the 41,600 pounds of raw material that's needed for production, and we figured that out up here, plus the 4,400 pounds that they want to have at the end of the month for the next month, and we subtract the 4,000 pounds that they already had on hand, and that gives us 42,000 pounds of raw materials that they are going to need to purchase throughout the month of May to be able to meet the May production and to be able to meet the June production requirements as far as having, 10% left for the next month and having the required percentages for the following month in June. So again, this question reinforces both the flow, which we learned in question 1, and the layered dependencies of budgeting. So we start with sales. We want to know how many finished units we have to sell, and then we go to production, and then that leads us to raw material needs. So again, we were able to start with finished goods, how much they need to produce. And then based on how much they need to produce, we were able to figure out how many pounds of raw materials they needed and figure out how much they needed to purchase in the month. So that was another piece of budgeting. Now let's go to the next question. All right, here we are at question 4. How much should Cedar budget for merchandise purchases in July? Let's go up to the top. Cedar Supply Co. estimates sales of $300,000 in July and $320,000 in August. The company's cost of goods sold is consistently 60% of sales. Cedar maintains ending inventory equal to 75% of the following month's estimated cost of goods sold. Beginning inventory on July 1st is $134,000. So again, how much should they budget for merchandise purchases in July? So again, take the concepts we've learned throughout the previous questions. This is a little bit different, but it's very similar idea. Pause the video, and when you're ready, come back. We'll look at the answer together. All right, here we are. The answer is D, $190,000. So let's go through this. To determine how much inventory needs to be purchased in July, Cedar first calculates the cost of goods sold for the month. Since cost of goods sold is 60% of July's sales of $300,000, COGS for July is therefore $180,000. Now they apply the inventory policy that we read about, which requires ending inventory to be equal to 75% of the following month's COGS. August sales are expected to be $320,000, so August COGS is 60% of the $320,000, giving us $192,000. So therefore, the desired ending inventory for July is 75% of that. 75% of $192,000 equaling $144,000. So now that we know that, we take the beginning inventory that we already had of $134,000, and we can calculate the purchases that they need to make in July the following way, the same way that we've been doing it throughout the whole video. $180,000 of COGS plus the $144,000 of desired ending inventory, subtract the $134,000 of beginning inventory that they already had, and that gives us $190,000 of merchandise to purchase in July. This ensures that Cedar has enough inventory on hand to, again, meet the current demand and maintain its policy that they have to have a certain amount for the next month's sales. So again, we're kind of seeing the same thing over and over again in just slightly different formats, but it's the same idea. Again, usually for these budgets, you take the production needs or the sales needs or whatever, plus the ending amount that you need to have for that specific unit or that specific material, less the beginning amount that you already have, and that will give you the amount that you need to produce or buy or whatever the case is. Now let's go to the next question. All right, here we are at question 5. What would be the total production cost if Madison Mugs produces 12,000 mugs instead? Okay, let's go up to the top. Madison Mugs, Inc. prepared the following static budget based on producing 10,000 ceramic mugs. Direct materials, $24,000. Direct labor, $16,000. Overhead of $20,000, of which $8,000 of it is fixed. All costs are variable except for the fixed portion of overhead, and we kind of could already know that from knowing that direct materials and direct labor are typically variable costs. So again, what is the total production cost if Madison Mugs produces 12,000 instead of 10,000 mugs based on the information we have? Now, this one's not too difficult if you just think it through. Pause the video, think what we've gone over in this video, and when you're ready, come back. We'll look at the answer together. All right, here we are. The answer is D, $70,400. That is the amount that it's going to cost for the flexible version of the budget. So let's kind of talk about that. To adjust the static budget, which is what we were given based on 10,000 units, into a flexible budget for 12,000 units, we separate variable and fixed costs and then scale the variable portion to the new production level. Remember, we talked about this a couple of videos ago. Variable costs do not change per unit, but they of course change with the production level, whereas fixed costs don't change the total amount, but the fixed cost per unit can change depending on how many units the fixed cost is spread across. So let's go through this. First, you calculate the variable costs per unit based on the $10,000 budget. So the direct materials was $24,000 divided by 10,000 units. That's $2.40 per mug. Direct labor, $16,000 divided by 10,000 units or 10,000 mugs. That's $1.60 per mug of direct labor. Variable overhead was, there's a total of 20,000 overhead, but 8,000 of it is fixed. So $12,000 of the overhead is variable. $12,000 of variable overhead divided by 10,000 mugs is $1.20 per mug. So now we can use those numbers, those variable numbers, to then calculate the amount for 12,000 units. We take each one individually, or you can even add it up. You can do it two different ways. You can either just do it one at a time, so 12,000 units multiplied by $2.40, 12,000 units multiplied by $1.60, and 12,000 units multiplied by $1.20, or you could add up each of these first, so $2.40 plus $1.60 plus $1.20, and then multiply it by 12,000. Either way, you'll get the same amount, so 28,800 plus 19,200 plus 14,400. Those are the variable costs, plus the already fixed overhead that's not going to change. It stays at 8,000. We add all that up together, and that gives us $70,400 of total production costs. This flexible budget reflects the expected total cost at a higher level of output while holding fixed costs steady and adjusting variable costs proportionally. So I think that should make sense. The variable costs changed with the amount of units that were produced. The overhead, the fixed overhead didn't change. So this one's not too difficult once you think it through. And again, you can do it one of two ways. You can either do the direct materials separately, then the direct labor separately, or you can add up the variable costs and then multiply them all together, like once you've added them up, by the amount, by the 12,000 units, and that will give you the same amount, but just in one number compared to 28,800 plus 19,200 and so on. So with that, we learned quite a bit in these 5 questions about preparing a budget. Now, before we do anything else, let's do one more part of the SuperFast CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 or 4 questions trying to teach you about preparing a flexible budget or about calculating the production needed based on, the ending inventory that you need and the beginning inventory and the sales that you need. Again, these are the things that you're seeing throughout the questions. And as you notice this, you are taking a moment and you're writing them out as pillar topics or the key points based on what you learned from the questions. And as you're doing this each day, you are building your own personal repository of the most important things you learned from the questions in your own words so that you are ready when you get to the exam. So with that, let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just dive straight in. First off, budgets typically begin with the sales budget, which drives the production budget, and then the direct materials, labor, and overhead budgets, and so on. Again, it almost always starts with the sales budget because that tells you what you want, and then based on that, you can start building the other budgets. The production budget accounts for both sales and inventory, calculated as budgeted sales plus desired ending inventory minus beginning inventory. And that same calculation right there, you can just switch a few of the wording out and you were able to use that same calculation over and over again throughout the video. The direct materials purchases budget depends on production needs using the formula materials needed for production plus desired ending inventory minus beginning inventory. Again, that's kind of the same thing said over again in a little bit of a different way. Purchases in merchandising firms are based on projected COGS and inventory policy, with COGS often calculated as a percentage of sales. And we saw that in, I think it was question 4. And then flexible budgets separate fixed and variable costs to adjust for actual output, scaling variable costs to the new level while keeping fixed costs unchanged. And so we saw that in question 5. So again, these are just kind of a summary or the general ideas behind the questions that we went over. And this is the kind of thing that you're going to be doing every day as you go through the questions if you're following the SuperFast CPA process. And with that, that is the end of this 5-question YouTube version of the video. Remember, SuperFast CPA Pro members are going to get access to the full 10-question version when we post it in the member forum. So if you like this and you like our other videos for the other sections as well, make sure you check out becoming a SuperFast CPA Pro member to get access to the full versions of the videos. And the easiest way to do that is actually by going to superfastcpa.com and signing up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam. And then after you watch that, you're going to want to learn more, and that will give you a really good path to learning about and becoming a pro member. So check out the webinar, then check out becoming a pro member. If you found this video helpful, I hope you did. Make sure to like it and leave a comment in the YouTube video. And with all that, I will see you in the next video.